New York City, I'm Shauna Smith alongside Brad Smith. This is Yahoo Finance's flagship show, The Morning Brief, the ultimate guide to help investors make smarter decisions for their portfolio. We're tracking early session volume while bringing you today's top market themes and elevating Yahoo Finance's most popular newsletter.
That's right. We've got a packed show for you this Tuesday morning. Retail earnings, they are pointing to cracks in the consumer, and shares of Macy's and Lowe's, they're moving to the downside on the heels of quarterly results. The cautionary consumer playing a key role in these reports amid a sticky inflationary backdrop.
And futures are little changed ahead of a fresh batch of economic data. Investors really searching for clues this week on any potential hints of a Fed rate cut. So let's get right to it with the three things that you need to know, your roadmap for the trading day. Yahoo Finance's Brooke DePalma, Madison Mills, and Jared Blickery have more.
Good morning. That's right. Shares of Macy's in the red this morning after reporting another quarter of declining sales as the new CEO looks to engineer a comeback after the retail giant rejected a buyout bid earlier this year. Now, the plan, he says, is designed to create a more modern Macy's that is expected to generate a meaningful value for shareholders in the years ahead. Once again, CEO Tony Spring saying that in Tuesday's release. Now, as part of this initiative, Macy's does plan to close 150 underperforming locations, including 50 by the end of 2024.
And shares of Lowe's moving to the downside in the pre-market trade this morning following misses on their earnings print in both sales and revenues. The CEO saying that shoppers are taking a more cautious approach to spending on those DIY projects as inflation does continue to remain sticky. Lowe's, though, reiterating its full-year outlook for 2024 will be impacted thanks to, quote, near-term macroeconomic uncertainty.
And futures searching for direction as investors count down the days to a crucial inflation report. Stocks losing momentum following the tumultuous run-up after Nvidia's earnings last week. And meanwhile, Bitcoin bulls are having a field day. Price of Bitcoin soaring to the two-year highs, topping 57,000, with gains buoyed by demand for spot Bitcoin ETFs and investments from MicroStrategy. Shares of Bitcoin miners and crypto exchanges, they are also rising alongside the leading digital currency.
Our top story this morning, we're getting a read on the consumer ahead of a key inflation report later this week. Overall, U.S. consumers are feeling more assured about the economy of late. The Consumer Sentiment Index rising in February to just under 80. That's up 19% from the prior year. But Americans are altering their spending as evidenced through earnings out this morning before the bell from retail giants like Macy's and Lowe's here. And what really showed up to me, Sean, in those two reports here is really the value moderation or value readjustment here that we're seeing from consumers, where these little luxuries, they're continuing to outperform in the form of Macy's. However, the DIY projects and some seasonality showing up in the mix here for Lowe's and impacting them.
Exactly. We certainly are starting to see more and more pressure on the consumer. We've been talking about for quite some time the fact that inflation is really making and forcing consumers to adjust their spending patterns right now. And we're seeing that reflected in many of these retailer reports, Macy's being one of them this morning, obviously launching a whole new strategy under their newly minted CEO there, Tony Spring. They're talking about changes that they want to make in the future, adjusting to this new reality that they are facing right now. And then when you take a look at Lowe's, not too far off from what we heard from Home Depot in terms of some of that weakness. But like you said there, Brad, a lot of Lowe's, or a lot of the reason that we're seeing even more challenges potentially here for Lowe's is because of their heavy reliance on the do-it-yourself product. The fact that it accounts for a significant part of their revenue, clearly weighing on the results this past quarter and also going to be a real challenge here for the sector at large for the coming quarters.
Yeah, one of the huge things, especially as we're kind of teeing up this conversation ahead of PCE, that personal consumption expenditures number, that is the Fed's key inflationary gauge that we're going to be watching for later this week here, is two factors that are really rounding out this consumer mindset right now. And it showed up within this most recent consumer sentiment print, which we're going to get another update on that on Friday as well from the University of Michigan. But it's going to come back to two things: the continued slowdown in inflation, but also the strength in the labor market too, where consumers feel comfortable, at least in the employment situation, having the opportunities out there in the market to either enter into a new role or get paid better in a current role. That's going to continue to weigh into the mindset as well.
Yeah.
Well, let's continue to talk about Macy's this morning. Macy's shares slipping on the back of its fourth quarter results, where the retail giant announced a new initiative that includes closing 150 locations through 2026. Yahoo Finance's Brooke DePalma has the details here. Ticker symbol M. We're tracking that this morning, Brooke.
Ticker symbol M, and it's day 23 for the new CEO, Tony Spring. So quite a lot that he's walking into. I mean, this comes as he approaches Macy's with what he says an outsider point of view after coming from Bloomingdale's, where he served as CEO since 2014 and joined Bloomingdale's right out of college back in 1987. But like I said, lots happening over at the ticker M at Macy's. They recently rejected a $5.8 billion buyout offer from one of its shareholders, Arkhouse. They now nominated 9 candidates for Macy's board of directors last week in a proxy battle. And he also hinted at a slowdown among its consumer. He said the consumer is expected to remain under pressure, especially as inflation has slowed, but so has labor and wage growth. And now this company out with this bold new chapter, its growth strategy, where the CEO, Tony Spring, said it has been its own toughest critics. It has challenged the status quo, and it has identified what it got right and wrong, and work is already underway. And if you could see here, these are some key tactics of that bold new chapter, including right-sizing its Macy's portfolio, closing 150 stores by 2026. He said that the economics there just made sense. They are set to close 50 this year with what they're calling non-go-forward locations. Now, this will be roughly 350 remaining Macy's stores. They're calling those go-forward locations, and they'll still be inclusive of a full line of furniture as well as smaller formats. They said that those 150 underproductive stores are set to close, like I said, 50 by the end of this year, but they said that it took roughly 6 to 7 months to really evaluate their portfolio. They ran a complete diagnostic looking at demographic, digital demand, the condition of the store. And in addition to that, they're also really trying to unlock value for shareholders by leaning into that omni-channel approach that we've seen do so well for companies like Amazon, like Walmart. They're really trying to rationalize and monetize their supply chain, lean into digital even more so, streamline fulfillment, and offer a scalable tech platform in the coming years. Of course, the pressure is on as Amazon and Walmart continue to gain share.
Yeah, two of their huge rivals out there. Right, Brooke, thanks so much. Let's continue with this conversation because Macy's, a top trending ticker here at Yahoo Finance. You've got shares sliding off just about 2%. After reporting comp sales fell just over 4%, 4.2% decline in the fourth quarter from a year ago. Now, the retail giant also announcing that new initiative that Brooke was just talking about, including plans to close 150 locations through 2026. For more on these results, let's bring in David Swartz. He is Morningstar's equity analyst joining us now. David, it's good to have you here. So the new CEO, Tony Spring, really trying to engineer this comeback, as our reporter Brooke DePalma put it just a few moments ago, describing 2024 as a year of transition, as a year of investment. I'm curious to get your thoughts on his plan here and whether or not it's really going to move the needle when it comes to stabilizing profitability.
It's hard to have a lot of confidence in it because this is not Macy's first turnaround plan at all. Macy's has been closing underperforming stores for years, and it certainly begs the question, if Macy's has closed all these underperforming stores, then why haven't its results improved? A lot of analysts, including myself, have long argued that Macy's needed to close more stores. So really, this plan is overdue. It's really long overdue. Macy's has a lot of stores and malls that are not viable in the long term, and this has been apparent for years. I would have to say that this is a really disappointing way to start out a new job as CEO at Macy's, having to close 150 stores and lay off a lot of people. That doesn't exactly generate a lot of excitement among investors or employees, I would imagine. And so at this point, it's hard to have a lot of confidence at all in Macy's turnaround plan.
And so, David, with that in mind, I mean, department stores have been struggling. Macy's is no different than any of the others in this kind of basket of players within the space. And looking across their portfolio, like you were mentioning, having to close stores, almost kind of tapping into some of the early elements of the Sears playbook. How do they avoid the demise that a Sears had to go through?
Macy's is still different than Sears. Sears had problems because it was primarily a hardware type of store. That's what Sears was known for. And Sears sold different stuff than Macy's sells. And so I do think there's a place for Macy's in the future. And in fact, I think the stock is undervalued. My fair value estimate is $25. And there's a reason why that investment group led by Arkhouse is interested in buying Macy's. Macy's does have very strong e-commerce. It does $7-8 billion a year in online sales. It has 40 million active customers, has millions of credit card holders. So Macy's does have strengths. The problem is that Macy's is operating a business model that doesn't work anymore and hasn't worked for years because the market no longer needs these 180,000 square foot department stores that Macy's operates. And so there's really been a transition that's been going on for probably 15 plus years, and it's really not even close to ending.
David, when it comes to some of the other plans that we heard here from Spring and what they plan to do over the coming years, yes, they're closing down 150 of the namesake stores, but they're also looking to expand Bloomingdale's and also Bluemercury. It looks like a bet here on the higher end consumer. Is that a winning strategy from your viewpoint?
I'm not sure that it is really. If Macy's is going to go more into luxury, they're going to be more competitive with stores like Nordstrom. And really, Nordstrom itself is not doing that well. There's really not much demand anymore for department stores for luxury goods because a lot of luxury products now are sold directly to the consumer by the brands themselves. Nordstrom has closed over 15 stores in the last few years, and so it's downsizing. Bloomingdale's only has fewer than 40 stores in the U.S., excluding the outlets. Now, it was clear, though, from the earnings call that most of the new Bloomingdale stores are going to be either Bloomies, which is a small-scale Bloomingdale store, or outlet stores. So they aren't really opening up new Bloomingdale stores. They're opening up smaller-scale stores. But in that category, they're way behind Nordstrom Rack, which already has 260 stores nationwide. So it's really going to be a long road to actually get that to be relevant.
You mentioned, David, at the top of this discussion, your price target and your fair value estimate of $25 for Macy's. For a lot of people out there who are hearing the buy the dip mentality start to emerge within the broader market run-up that we had seen, is Macy's a company that's missed out on much of that run-up? Are they worth buying this dip?
You can make an argument that Macy's real estate is worth more than the market cap of the company. I mean, so there is an argument to be made that Macy's has hidden assets that are actually valuable. And this is why there's interest in buying Macy's again. There have been activists looking at buying Macy's now for years. And it's because Macy's has significant real estate and they have a large online operation, some of the other strengths that I talked about. There has to be some concern, though, that the company just keeps getting smaller. The revenues go lower every year. Closing 150 stores runs the risk of losing customers that may never come back. So it's unclear that there's really any growth plan at Macy's at all, but there is real value at Macy's. It is still the largest U.S. department store. There are still major brands that rely on Macy's, like, for example, Ralph Lauren and Tommy Hilfiger and Calvin Klein. There are brands like that still invest in Macy's and still want Macy's to succeed. And I do think that there's a future for Macy's. It's going to be a smaller company, but I do think that is more than reflected in the current valuation.
All right, David Swartz, always great to get your insight. Thanks so much for hopping on and reacting to Macy's earnings report out this morning. Again, shares under pressure in the pre-market. Thanks, David.
Thank you.
Let's get to today's stock to watch, and that is shares of Lowe's are under pressure this morning, off just about 1.5%. Reported comp sales that fell just over 6% from a year ago. The home improvement company also expecting a further slowdown ahead. Yahoo Finance's Madison Mills on the floor of the New York Stock Exchange with the latest on some of the pressure that we're seeing across the board, Maddie.
Yeah, Shauna, this is another interesting name to watch when it comes to two separate things that are weighing on a lot of different aspects of the earnings season this cycle. One of them being the higher for longer mentality for the Fed, and the other being the bifurcation we're seeing in the consumer. So just to run through how we're seeing both of those dynamics playing out in Lowe's in particular, as you mentioned, sales falling underneath estimates from this earnings cycle. And this comes after the CEO had already cut their yearly forecast back in November, stating that the pullback in consumer spending on those optional home renovations projects was a lot higher than they had originally anticipated. Now, what that signals to me is that a higher for longer environment is not going to be good for a name like Lowe's. The people who were stuck in their lower mortgages, lucky for them, were looking around seeing how they could instigate some home renovation projects throughout the pandemic when they were more likely to be working from home. Now they're kind of buckling potentially under the weight of stickier inflation, and they're not as interested in spending on those optional home renovation projects. We got a clue about this from Home Depot as well last week, who indicated a similar situation with their customer base. Now, moving forward, I'm curious to see how Lowe's is going to plan to strategize around that consumer. We heard from a Macy's today, for example, leaning in on those more expensive names and products like a Bluemercury as opposed to Macy's itself. They'll be closing some of those stores. How will Lowe's strategize to meet the consumer that can withstand the weight of inflation, while those who are struggling a little bit are starting to pull back on their spending?
All right, Maddie, great synopsis there. We'll check back in a little bit closer to the opening bell. Also shifting gears this morning to a trending ticker on Yahoo Finance's site and a trending currency. Bitcoin, we'll start there, topping $57,000 earlier this morning for the first time in over 2 years. We're seeing it trade now around $56,811.24 to be exact. The rally largely attributed to demand around spot Bitcoin ETFs plus investments from MicroStrategy, which scooped up over $155 million worth of Bitcoin in the past couple of weeks. For more on the rally, we turn to Mark Palmer, Benchmark Managing Director and Senior Research Analyst. Mark, always a great pleasure to get some of your insights and analysis here. Particularly, you're focused in on MicroStrategy, but if we kind of pair together what we're seeing, because a lot of the MicroStrategy story now is hinging on Bitcoin as well. What does Bitcoin need to get up to in order for it to hit some of your targets that you've got set forth for MicroStrategy?
Yes, good to talk to you. Our assumption is that the price of Bitcoin is going to achieve $125,000 by the end of 2025, which, as you can see, the stock, the price of Bitcoin had been around 57,000. So that's a big move. But why do we have confidence that that's going to happen and it's going to accrue to the benefit of MicroStrategy? Really, it comes down to supply and demand. As you mentioned, there's been significant demand for Bitcoin since the 9 spot Bitcoin ETFs have launched following the SEC's approval of that structure in January. That's been amazing in terms of the volumes that we're seeing across the board. At the same time, we are now approaching a milestone in the Bitcoin ecosystem, the so-called halving, which is slated to occur at the end of April. Every 4 years or so, you see the mining rewards that are paid to Bitcoin miners cut in half. This has happened 3 times since in the history of Bitcoin in 2012, 2016, and 2020. And in each case, we saw a rally moving into the halving and then a bigger rally for the next year plus afterward. This is, again, simply about new supply being curtailed. It's really crucial to the mechanism behind Bitcoin because that controls inflation, which is where Bitcoin is seen as an alternative to the US dollar and other inflationary currencies.
Mark, and then you also have the anticipated approval potentially here, the Ether applications, which could be another catalyst for crypto. All in all, when we talk about this rally, whether or not it has staying power, what do you think that upside then looks like for some of these cryptocurrencies?
Well, again, we focus primarily on Bitcoin in this context, but we're seeing a setup such as we have never seen before. Now, I say never seen. The history of Bitcoin only goes back to 2008, 2009, but still, we've seen some massive rallies and massive pullbacks. This go round, we have the confluence of not only the halving, but one of the biggest tailwinds we've seen for this space. The wholesale adoption of the cryptocurrency by institutions. And of course, Bitcoin is that odd asset class insofar as retail really led the demand for it for the first decade plus of its existence. It's really now that there's the opportunity for institutional investors to come in. MicroStrategy is one way to play that. For institutional investors, frankly, we see some benefits versus spot Bitcoin ETFs in that regard. simply because MicroStrategy is still throwing off free cash flow from its software business, using that to buy more Bitcoin. It's issued $2.2 billion in debt, used the proceeds from that to issue Bitcoin. So it's a unique vehicle in that regard, that it's not simply a passive investment. It's a company that is actively positioning to make an intelligent leveraged bet on Bitcoin.
Mark, what crypto touching companies perhaps, or even crypto platform company from your analysis across this industry is best positioned to really capitalize on any furthering of this rally within crypto?
Well, again, I have to come back to MicroStrategy simply because if you look at the correlation coefficient, the correlation between Bitcoin and MicroStrategy, it's 0.94. So if someone can go out and buy Bitcoin in the market, fine. But many institutional investors in particular do not have the ability to do that under their mandates. And so this offers an attractive alternative. And again, on a levered basis. There's also a robust option stack around MicroStrategy, and the stock itself is marginable. So you can't hedge effectively with a spot Bitcoin ETF. You can hedge very effectively with the capital structure around MicroStrategy.
All right, Mark Palma, thanks so much for joining us here this morning. We appreciate your time. Again, Bitcoin just above 57,000. All right, well, coming up, Kava shares climbing higher today, boosted by strong customer traffic. We're looking at gains just over 8% in the pre-market. We'll break it all down for you in Yahoo Finance's top trending tickers next. Kava shares jumping following the company's solid earnings results here before the bell. Now, same-store sales rising 11.4% from a year ago, easily surpassing the 6.3% rise that analysts had expected, so nearly double what the street was forecasting. This coming after the restaurant chain saw a boost in customer traffic as well. Now, it was a surprise release here for Kava. There was a bit of an embargo break, it sounds like, after the bell yesterday, so we're seeing the company adjust just a bit, holding their earnings call as we speak right now. But again, Brad, going back to what we really started here with when it comes to the strength of the consumer, this is another name showing that, hey, consumers that are still spending, they're out there spending, and they're spending a lot on some of these more fast food, fast casual types of restaurants. Cava obviously being the beneficiary of that and really proving the fact that they have staying power within a very competitive landscape.
Yeah, Cava, a two-factor beneficiary here of especially the workplace environment. You think about the amount of companies that are starting to reinstitute once again now some of the back to office or return to office mandates as well, whether that be a fraction of the days of the week or full time. They're getting a little bit more of that share, and you think about kind of even our own mix. I mean, I go to Dig In, I go to, I go there way too much. So, but Cava would love to get some of my dollars. Anyway, one of the huge things that really jumped out to me about this report was the fact that they said digital revenue mix was 35.9%. So you think about that. Essentially, more than 1 in 3 of the orders are powering that digital number and coming in through digital. That is a connection point. That is the digital and the relationship that you're able to kind of further and perhaps institute even more demand generation through those digital touch points as well. So I think that's significant in growing out this brand on a continued basis as well. Also, another top trending ticker that we're watching here. It's funny, they always give me the cruise line reads. Interesting how that works. Norwegian Cruise Shares getting a boost in the pre-market after giving first quarter guidance well above expectations. They know that I won't step foot on a cruise. That's why they do it to me. The company also reporting a 32% jump in revenue from 2019. Now, there's really a lot, and you're taking a look at some of the actuals versus the estimates. It was a mixed bag here at the end of the day, but one of the things that really kind of jumps out to me continuously about this is the new fleets that we're going to see come forward. Also, the Oceania Cruise brand, that already had seen some of the single-day sales or booking records. So I think that's critical. Occupancy, that was 102.9% for the year. I don't know how you have more than 100% occupancy, but hey, they found a way. And ultimately, the passenger cruise day increased approximately 17% or 18% revenue per passenger cruise day, I should say, increased approximately 17% as well.
Yeah, Brad, you might not be taking a cruise, but a heck of a lot of people are, and you're seeing that reflected in some of the numbers that you just went through and really putting a bow on all that. It's record level of bookings here for an industry that a lot of people were questioning whether or not it was even going to be able to bounce back from the lows that we saw during the pandemic, whether or not people were going to feel comfortable going on a cruise again. And it proves 4 years after the pandemic started here that people are in fact comfortable. Advanced ticket sales ending 2023 at a record high of $3.2 billion. That's up 56% compared to where it was at the end of 2019. And that improved demand, it's giving Norwegian, it's giving many of its rivals some flexibility or some pricing power, I should say. They're able to charge a little bit more for these trips and therefore offset some of the higher labor costs that they're facing, the higher fuel costs that they're facing. So setting up Norwegian really nicely here at the start of 2024. It's full year profitability for the first time since 2019.
I'm just looking at pictures of these vessels. I mean, this was the most deliveries that they had taken in a year here. They are very nice. So we'll see what the ultimate reviews are from some of the people hopping on these new fleets out there.
All right, we'll get right here on Yahoo Finance. Much more of your market action ahead. We've got the opening bell in just under 3 minutes.
Just seconds away from the opening bell on Wall Street. Big consumer energy this morning here as we've been tracking some of the earnings that have come out. Plus data, economic data this week. We got PCE plus, another read on the consumer sentiment equation later on. Plus we got jobs day too here. There you're taking a look at the opening bell. Let's set sail on this trading session here. You've got a live look at the NASDAQ and the NYSE. NASDAQ has funfetti. NYSE, I was trying to take a look at it. It's gone now. Well, on the floor of the New York Stock Exchange, you've got Maddie Mills also trying to, I don't know what you're looking at.
She's also trying to take a look at what's happening up there, too.
Yeah. Maddie, you're standing by. Jared Blickery's standing by. Maddie, let's go to you first.
Thank you. Thank you, guys. Yeah, I'm trying to look at the tickers because my screen got turned off this morning. But if I'm reading them correctly from about 50 feet away, it does look like we're opening in the green this morning, which is a change from what we saw yesterday. The S&P snapping those gains and closing in the red a little bit there following that record-breaking earnings print from NVIDIA. Interesting to see that 25% of the volume and movement that we're seeing in the options market is still related to calls on that name. So I'm curious to see whether that's going to drive the trade moving forward. My sources here today telling me they're hoping for something big today. Now, whether that comes from the consumer confidence print coming up at 10 a.m., like you mentioned, Brad, or maybe we have to wait for some more movement until later in the week with that PCE print remains to be seen, but hoping to see a little bit more conviction and something to trade on this week after the market kind of digests that AI-driven rally following NVIDIA. Now, I am interested to see whether or not the news that we got out of Macy's and Lowe's this morning is an indication of some kind of sickness within the broader economy. Our very own Miles Udland might disagree with me on that. He has a great piece you can read on the Yahoo Finance platform this morning about the market sort of being indicative of the economy to a degree, and the market's looking great right now. But if you look at the earnings prints and the details from Macy's, from Lowe's, we are starting to see a little bit of weakness, particularly in the lower income consumers. I'm curious to see what happens with that moving forward, particularly given the higher for longer stance of the Federal Reserve.
All right, Maddie, thanks so much. Teeing up today's trading activity. Also here at the home base, we've got Jared Blickery standing by at the Wi-Fi Interactive. Hey, Jared.
That's right. I got a line of sight on these quotes here. Maddie, with the eagle eyes, I remember how difficult that could be, find those quotes on the big board. But the Dow is slightly underwater today. Russell 2000 up 1.3%. It's been an outsized leader both to the upside and the downside today. It's to the upside. And the NASDAQ composite at about 0.25%. Now, the sector action lately has been really interesting. We saw risk markets really take off yesterday, and the risk universe has been expanding. Now, today we have consumer discretionary, real estate, and utilities all leading, so kind of a defensive mix along with some retail in there. By the way, healthcare trading to the downside 0.5%. But check out what's happened over the last month. We have consumer discretionary, that's retail, still in the lead, but then we have industrials, materials, healthcare, finance. You're not going to see any tech names in there, although you do get some crossover with Amazon and XLY. But for the most part, my point is we're seeing this rally broaden out. And even today, we're seeing it in some of the fringier parts of the market like tech. And let me go to disruption here. Here we go. This is a one-day view. Zoom up 9%. That's buoyed by its earnings today. Coinbase up over 5% after a monster day yesterday, and that's all on the Bitcoin frenzy. See if we got time for that later. But here's Coinbase up 250% over the last year. Just had a huge break to the upside yesterday. Let's see what else I got time for in a few seconds that we have left. Crypto leading for the second day in a row. Got disruption, solar, IPOs. Very green day here.
It is a green day, at least for right now, 3 minutes into the trading day. Hopefully it all holds. All right, Jared, thanks. Let's take a look at the major averages because they are still mixed here right after the open. Now, investors eagerly awaiting some more key econ data that's out later this week. One of those is another reading on inflation, where investors are going to be parsing through that report looking for any clues as to when the Fed could potentially cut rates. Now, to break it all down for us, we want to bring in Megan Horniman, Verdin's Capital Advisors Chief Investment Officer. Megan, it's good to have you here. So it looks like, at least for now, earnings giving investors enough of a reason to stay in the market, to stay optimistic about where things stand. That inflation print, though, that we'll get later this week, how should investors be bracing or positioning themselves ahead of that print?
Well, we got that surprise print in the CPI. The PCE is the composition is a little bit different, so it may be a pleasant surprise for investors. But what we're seeing is there still is inflationary pressures in the economy. Even if you look at house prices that came out today, on a year-over-year basis, home prices are rising again, and this is concerning because this filters into that sticky inflation component of the owner's equivalent rent and shelter in that CPI, and that's something the Fed's definitely watching. We're just coming into this market. What we've seen is this momentum-driven rally around AI and technology. This is something that you have to be cautious of. Valuations are getting pretty lofty in these areas. So we're a little bit more defensive with our equity positioning.
And so that's what I was just about to ask, Megan. If we continue to see persistent or stickier than anticipated inflation, especially in certain pockets here on the services side or even in housing specifically as well, as you were mentioning a moment ago, how does that adjust the portfolio strategy?
So we came into this year with the expectation that we didn't think the Fed was going to be able to cut as much as the market was pricing in. We are neutral, our global equity exposure, because we do think we're towards the end of that tightening cycle. We're not in the beginning stages. So you want to be in this market, but you don't want to be significantly overweight when the expectations we think are just way too unrealistic. I don't think the Fed's going to be able to cut interest rates until at least the second half of this year. And I don't think we're going to get I think at the beginning of the year, there was 7 of them priced in. I think now there's 4 or 5. I even think that's a little bit more aggressive. So when the market starts realizing that's not a possibility, I think there's room here for some volatility.
You talk about volatility there, Megan. There certainly is a debate that's forming that has really been brewing now for quite some time when it comes to some of those tech valuations and the massive run-up that we've seen in a handful of names. Is it right to draw some of those bubble comparisons to what's happening right now back to the dot-com bubble? Or I guess, how are you looking at the current valuations of some of those leading names?
Well, I think you can draw comparisons to any different bubble that you see. It doesn't necessarily have to be the dot-com. I think people are trying to draw a comparison to the dot-com bubble because it's technology, and this is technology again. But look at the way that some of these names or their valuations or the run-up and compare this to any other bubble. Yes, I think they are looking bubble-like. I think there's room for some, I guess you could say, valuation correction here with some of these names.
What are some of your top picks that you see opportunities for in the market right now, Megan?
So as I mentioned, we're neutral, our global equity exposure versus our benchmark. But when you look at the U.S. large cap market, even value and growth are both expensive. But from a sector perspective, be a little bit more defensive. Healthcare, consumer staples, over consumer discretionary. Those are some of the areas we would focus on. Once we get closer to, I guess, a Fed rate cut, once we get a little bit more clarity around the economy, there's areas that have really not participated that we want to get some exposure to. So looking at small and mid cap stocks, these have really trailed this large cap momentum rally, and those are some areas that we'll look at to invest for the long term.
You mentioned earlier, and we'll end on this, that you don't see a cut until the second half of this year, most likely. How many cuts would investors be apt to price into their portfolio at this juncture?
I know that's a tough one right now to say, I think, because the inflation situation is still so unclear. But I'd say, we're looking at beyond the summer, maybe, 2 or 3 rate cuts at the most.
Megan, always a pleasure to get some of your insights and analysis. Megan Horniman, who is the Verdence Capital Advisors Chief Investment Officer. Thank you so much.
Thank you.
Coming up, everyone, Chevron's $53 billion mega deal for Hess might be at risk. We'll tell you why on the other side.
Well, Chevron's $53 billion mega deal for Hess might be at risk. Exxon and China's CNOOC is saying that they have a right to counter Chevron's bid for Hess's stake in an oil project off the coast of Guyana. Now, we want to head over to Yahoo Finance's Ines Ferre standing by to break it all down for us. Ines, this could be the start of a very, very, long-standing dispute.
That's right, a lengthy one. Now, Chevron announced that it was buying Hess last year. You'll recall that. And a big reason for that deal was because of Hess's Guyana oil block asset. Now, ExxonMobil and China National Offshore Oil Corporation, CNOOC, are asserting their right, they're saying, to preempt the purchase of that stake in that oil project, which is a key part of the merger deal. Exxon owns about 45% in the Stabroek project, of which it's also an operator, and CNOOC owns about 25% of that project. The other 30% is owned by Hess and would be passed on to Chevron as part of the deal. Now, in a statement, ExxonMobil said that it is engaged in conversations with Hess and Chevron, and those conversations are going to continue. They also said we owe it to our investors and partners to consider our preemption rights in place under our joint operating agreement to ensure we preserve our right to realize the significant value we've created and are entitled to in the Guyana asset. There was little interest really in Guyana. This is a small country next to Venezuela until ExxonMobil made a big discovery in 2015. And since then, they've made dozens of other discoveries in the region. But this really underscores that value in the Guyana project. It's also a ground jewel for Hess. And this is part of the reason, a big reason, why Chevron wants Hess. In a statement, a Chevron spokesperson said that there's no possible scenario in which Exxon or CNOOC could acquire Hess's interest in Guyana as a result of the Chevron-Hess transaction. What is the street reaction to this? Well, we're seeing that Hess is down about 3%. Chevron is slightly lower. ExxonMobil up about 0.8%. This likely could be something that could be extended. I haven't heard any analyst, though, guys, that is saying that the deal is off because of this, but certainly a challenge or a roadblock, so to speak.
Well, we'll certainly be keeping tabs on whether any of the analysts change their tune for sure. Yahoo Finance's reporter Ines Ferre, excellent job breaking that down, Ines.
Thank you.
Shares of Unity Software plunging this morning after forecasting adjusted earnings for the first quarter of $45 million to $50 million. That's well below the $113 million that was expected. This comes after the company slashes 1,800 jobs. They did that back in January. That was about a 25% workforce adjustment as they had put that news out earlier this year. And that came as part of this portfolio reset, which they gave us a little bit more color on, resetting the portfolio to focus more on core businesses, which they refer to as this strategic portfolio, the engine, the cloud, and monetization, and narrowing their investments in new businesses to those most attractive and mainly industries particularly.
Yeah, certainly. I think when it comes to this name, there is a turnaround taking place, at least in the eyes of some of the analysts. But the issue that I saw in terms of the quick reaction that we were getting from analysts here this morning, Brent Thiel's kind of summed it up with just one line, saying that there is a lack of clear strategic direction right now. We saw that with revenue falling short of expectations. Overall, the results, at least for the previous quarter, were a bit disappointing here. You can see, obviously, a wider than expected loss. Revenue, though, did beat. But in terms of how that sets up the company here moving forward, I think there's lots of questions just about the cost cuts that are taking place, how long that's going to take in order to start really paying off and really have an impact on the bottom line, and also just the direction of the company going forward. Analysts, at least right now, want a little bit more clarity into exactly how long this turnaround is going to take place.
Yeah, and it's really interesting at what price they're going to be able to continue to put solutions into the market. When you look into this turnaround plan as well, exiting hardware components of their multiplayer business, shifting their services to orchestration and managed solutions, stopping the independent development of professional artistry tools. It's a larger question of where, for the integration of the Unity editor and the AI tools, they're going to be able to implement price, and that a lot of the core customers that have used these tools and services will continue to buy into that ecosystem as well. And I think that's something that analysts like Brent want to hear more about, that monetization strategy and what the margins continue to look like on the back of that as well.
All right, well, let's take a look at Sony, because shares are roughly flat this morning after announcing that it is laying off 900 employees across its video game division worldwide. This will impact about 8% of its workforce. Now, the company also closing its London division. This is part of the cuts that were announced today. The CEO of Sony Interactive saying in a note to staff that this morning that the cuts are needed to, quote, continue to grow the business and develop the company. Now, this announcement comes on the heels of what was announced just about a week or two ago when the Japanese gaming giant here cut its sales forecast for the PlayStation 5 console. That was back on February 14th, warning of lower demand. So the company's being forced to make some adjustments, this time joining a long list of companies, Brad, that you and I have talked about many times over the last several weeks, are being forced to cut headcount in order to better position themselves for the rest of 2024.
Yeah, really impacting the PlayStation community. At Sony here, they, in a blog post, confirming this news and saying that they envision reducing the headcount by about 900 people, as you mentioned, 8% of the workforce. Several PlayStation studios are affected by this. The company did note PlayStation Studios London closing in entirety. You've got reductions in the Fire Sprites studio as well, reductions across various functions in SIE in the UK as well. So a larger kind of inclination here that the company also feels it sounds like implementing a next career support program as well as part of this. But this, no doubt, not an easy decision it sounds like the company needed to make. And you think about the broader environment too, where we've seen so much shift as well in the difficulty in making sure that you're building out titles, and in the console business for PlayStation, for so much of that has shifted to cloud consumption of gaming as well, whether that be mobile or whether that be a console that connects to the cloud. That places a larger question on, okay, what are the titles that are actually going to continue to drive console adoption or console purchases, and how does Sony need to readjust as they're doing here to make sure that they have the necessary headcount to operate efficiently within that manner, yet still put a very compelling product out into the market right now.
Yeah, Brad, similar to what you're saying, I mean, this is an issue that the industry at large is struggling with, right? When we talk about the slowdown that we have seen play out across the gaming companies since we were in the midst of the pandemic, since we did see rapid adoption, so they're being forced to adjust headcount as a result of this. And Sony joining Microsoft earlier this year, saying that it's laying off 9% of its gaming unit after it completed the acquisition of Activision Blizzard. A number of other competitors have also been forced to adjust their business at this point. So Sony, the latest here to announce the job cuts.
Absolutely. Well, coming up, everyone, we'll dig into what big tech earnings estimates mean for the market's performance this year. That is after the break. All Magnificent Seven companies have reported their fourth quarter results. The majority seeing upward estimate revisions, an average of over 7% for the quarter. That's according to DataTrack. Now let's bring in Yahoo Finance's Josh Schaefer for more details on this. Hey, Josh.
Yeah, Brad, DataTrack did a great job breaking this down in their evening note last night, and I want to sort of zoom out a little bit here and take a look at some of the other earnings revisions they had. So we had earnings from all of the Magnificent Seven companies, and then of course the big question is, well, what do analysts think are now going to happen for the current quarter, for the next year, and maybe even out into 2025, right? That's sort of what gets priced into these stocks. So if you take a look here, this is what's changed in earnings estimates over the last 30 days. So this is not expectations for next year necessarily directly. It is what has changed in the last 30 days. You see, really, I think the takeaway here, Shauna, you're looking at it. There's only 3 companies, right, that really saw big changes, right? Mm-hmm. And that, to me, is one of the prevailing takeaways here. NVIDIA, Amazon, Meta, the big 3 winners of this earnings season. You can see Alphabet actually had its estimates upped a little bit, but we were talking about this off air and sort of discussing what do we learn from this? And I think it's the 3 companies there. And then if you look at year-to-date performance in these stocks, you probably have to give Microsoft a little bit of credit. Microsoft's up about 8%, so a little bit over the market. So maybe we'll call it 3.5. But to me, the prevailing takeaway that we've seen in earnings projections movements is maybe we're not talking about the Magnificent Seven. Maybe it's the Fantastic Four or the 3.5. I don't know. But it seems like we're no longer in this 7 tech stock phase, and it's certainly narrow.
The triple threat, yeah.
Triple threat.
That was
There
a
we
good
go.
one. Okay, I was sitting over here trying to come up with something quick. You beat me to it. But Josh, I think also for investors, right, is what this means for the broader market, right? Zooming out even more, talking about how this is factoring into S&P projections for year end. We've seen a number of analysts, even this week with Barclays out this morning, upping their target even more.
In most of these strategists that are coming out and saying they expect the S&P 500 to rise higher, so Barclays coming out and saying that they think it's going to go to 5,300. They're boosting their target from 4,800. The main driver of that is big tech. So they're saying they think the economy is going to hold up well, which is of course important because big tech also needs the economy to do well, right? But then they're also highlighting that they think that big tech is going to be the big outperformer here. And they said in this release here, in their research, they were highlighting overall how much more big tech is worth in the earnings story than the rest of the S&P 500 and really the rest of big tech. If you were to remove big tech, I'm looking at their projections for the full year 2024 right now, you're talking about the rest of the S&P 500 being at like $177 worth of earnings instead of when you add in big tech, you get $46 more worth of earnings in that. So it's a significant increase when you're adding in big tech and adding in those high expectations. That's what's driving these targets higher right now.
Seems like nothing stopping. What is it? Triple threat? Or
Triple
Fabulous
threat,
Four?
the trifecta, the hat
One
trick,
day, we got to just do 2 hours on just the triple threat. We'll just talk about the 3 stocks.
triple
You're onto
double.
something.
It's all the,
Yeah.
it's,
Gonna
you
rate
know,
well. It's
who
what the
needs the
people want.
497?
Nobody.
Josh, thanks so much for breaking that down for us. Keep it right here, though, on Yahoo Finance. Much more to talk about other than the triple threat. We're going to be talking Lowe's shares falling on the company's fourth quarter earnings results. We've got analyst reaction when we come back.
Welcome back to Yahoo Finance, everyone. I'm Brad Smith alongside Shauna Smith. We are 30 minutes into the trading session here today. Let's take a look at how things are shaping up. Stocks mixed as investors digest the latest retail results, pointing to a softening consumer. We're also awaiting a fresh batch of economic data as traders are searching for clues of the potential timing for Fed rate cuts. Let's get to some individual movers that we're tracking here today. First and foremost, Micron shares climbing higher after announcing a collaboration with Samsung to bring AI experiences to mobile devices. The chip maker's memory cards are going to be used in Samsung's Galaxy S24 series. Now, this follows news out Monday that Micron is increasing production for its memory chips used in NVIDIA's AI semiconductors. And Zoom shares are jumping this morning, zooming, some might say, after delivering better than expected results in its fourth quarter and announcing a share buyback of up to $1.5 billion. Despite the upbeat reception from the street, an analyst at JP Morgan saying in a note this morning that the results do not convey a materially improving business. And shares of AutoZone, they are on the move. They're higher by about 4.6% after reporting a better profit than expected in its second fiscal quarter. This is thanks to a rise in the do-it-yourself trend, and the strong demand AutoZone saw in the quarter echoes what we heard from competitor O'Reilly's a couple of weeks ago as consumers hold onto their older cars here. We're continuing to track shares up this morning.
All right, well, home prices rising once again in December, up just over 5%. That's according to the S&P Case-Shiller 20-City Home Price Index. Our very own Danny Romero is here with the details. And Danny, just another month of another rise in home prices.
Home prices the data is actually playing catch up. The small increase that we saw in December is really a backward looking data that's still capturing the slowdown in home prices, home price growth following October's peak in mortgage rates. Remember, last year in October, mortgage rates were hovering around that 8%. And if we take a look at that 20-city index, that tracks home prices in the 20 largest U.S. metros. That increased 0.2% month over month and 6.1% year over year on a seasonal adjustment. San Diego, Los Angeles, Detroit posted the highest gains on a year over year basis. Portland increased on a monthly basis, but still the smallest growth on a year-over-year side. Bottom line, economists expect that home price growth will stay robust, the resale market will stay tight. However, there is expectation that buyer demand will recover partially, and that could heat up some competition. But again, this price gain really does exacerbate the housing affordability issue. Homes were 6.7% less affordable in December on a yearly basis, and that's according to the National Association of Realtors Affordability Index. So still a lot of pressure for buyers right now.
Yeah, absolutely. This is just another data point that we've seen on the housing sector. Danny, thanks so much for breaking this down for us. Appreciate it. We're also tracking shares of Lowe's this morning. They are on the move after its quarterly results. They are higher right now by about 2.7%. They beat on the earnings, top and bottom line annual profit, and sales missed the street's expectations, sending shares lower here. Shoppers taking a more cautious approach to spending on those DIY projects against a sticky inflationary backdrop. For a deeper dive into the company's latest results, we're joined by Michael Baker, D.A. Davidson Managing Director and Senior Research Analyst. Michael, great to have you here with us this morning. You look through this report. Ultimately, what is the takeaway as you hear Lowe's talking about unfavorable January? You hear them talking about the DIY impact that they're seeing as well in some of those projects being pushed out.
Yeah, sure. Well, the fourth quarter was down, but we knew that, and it was actually down a little bit less than expected, and wasn't a bad quarter at all. As it relates to the outlook next year, again, we knew they'd guide to a lower number in 2024 than in 2023. It was a little bit softer than expected, but not too bad at all. We think they're sort of, doing well internally against a tough macro backdrop. For instance, their expenses were flat on a year-over-year basis relative to sales, despite a really big decline in sales. So they're controlling what they can well. Gross margins up slightly. That's all good against a tough environment. So I think that's why the stock, it did open down a little bit, but now it's back up because I think we're seeing the company control what they can pretty well here.
So, Michael, the company's doing what it can to control some of those costs. But when we talk about the recovery, I guess from what we learned today from the most recent quarter, how far out does that then push this recovery timeline?
Yeah, not 2024. Maybe second half of 2024. But we don't want to sort of get too far ahead of ourselves yet. We think same-store sales will continue down, certainly for the first half of the year, and probably even for the second half of the year. So still a little bit to go on the housing recovery here. Getting better, but we're not looking for positive until maybe early 2025.
And so for some of the projects that are being pushed out, it's not just the DIY, it's also that pro segment too. Where do you kind of read into that and get a sense of where this could potentially still continue to be a lingering headwind for Lowe's?
Sure, the industry is soft on both sides for sure. Lowe's, though, is taking share on the pro side, and their pro business was actually flat year over year. Not bad at all in this environment. Compare that to to Home Depot, who had a negative trend in their pro business. So Lowe's is taking share in pro. Now, to be fair, from a smaller base relative to Home Depot, but pro is probably would be considered a bright spot in Lowe's quarter. Again, positive or flat, I should say. Better than the industry.
Michael, when it comes to what would be fair value here for Lowe's, given the movement that we've seen in the stock, some of that uncertainty already being priced in, has that been priced in up until this point?
We think it has. We think Lowe's, again, all expectations were for a negative comp and to be negative for 2024. Again, maybe a little bit softer than expected, but no surprises here. In the way the trend is going, and the valuation is about average versus history, but we think pretty modest at this point.
This total home strategy that the company has put forward, that we've heard Marvin Ellison talk about as well here, where would you say that they're at in that total build out of the strategy and implementation as well right now?
Yeah, they're doing still room to go on that. Again, as I said, they're doing well relative to a tough environment, but they still lag Home Depot in a number of areas, particularly on the pro side. And we think that's a key part of the strategy is to grow that pro business. In fact, that's probably the biggest difference in total sales per store between Home Depot and Lowe's. Their DIY sales per store are actually pretty similar, but the pro side, Lowe's, less than half of what Home Depot does in terms of pro sales. So that's the biggest area where they can continue to improve.
All right, Michael Baker, great to get your insight here this morning. D.A. Davidson, Managing Director and Senior Research Analyst. All right, the Conference Board's consumer confidence coming in lower than expected for the month of February. This is breaking news just minutes ago, coming in at 106.7% on the index. That was down from a revised 110.9 in January. Now this decline here snaps the 3 consecutive months that we did see of gains. So some of that confidence here in the economy deteriorating just a bit. In terms of where we are seeing that deterioration, the Conference Board highlighting the fact that confidence fell for consumers under the age of 35 and those also 55 and older, whereas it did improve slightly for those aged 35 to 54. So I thought that was an interesting nugget here within this report. Obviously, those that are in the prime here of their income years feeling a little bit better about where things stand here within the economy, but certainly we did see a decline when it comes to that overall number across the board.
All right, I'm waiting for that next birthday then, obviously, to get into that particular bracket where they're seeing a little bit more confidence. But one of the data points that we got are actually one of the quotes that we got from Dana Peterson, chief economist over at the Conference Board and good friend of the Yahoo Finance show here. Declining consumer confidence in February interrupted a 3-month rise reflecting persistent uncertainty about the U.S. economy, saying, to your point, the drop in confidence, broad-based, affected all income groups except household earnings of less than $15,000 and those earning more than $125,000. So you've got a wide range in between that as well, for sure.
And there was also some renewed pessimism within this report regarding the future of business and labor market conditions. So we'll get the next reading on the jobs report in just a week or so from now. But again, the deterioration there in terms of confidence that we're seeing within the employment picture, which could be a warning sign here for the broader market. All right, well, coming up, the single stock call options are surging. We are going to break down how you can cash in next. Shares of J.M. Smucker edging slightly lower this morning, off just over 1% after reporting third quarter results that beat on both the top and bottom lines. Now the company also looking to maintain some of its momentum against a pressured consumer environment. Joining us now, we want to bring in Mark Smucker. He's the president and CEO of the J.M. Smucker Company. And we also have Yahoo Finance's very own Brooke DePalma joining us here on set. Mark, it's great to have you. Overall, it's a strong quarter here for J.M. Smucker. Clearly, that demand remains, a lot of that being tied to some of your frozen offerings as well as pet food. I'm curious what you can share just about some of the trends that you're seeing from the consumer and how it differs than what we saw 3 to 6 months ago.
Yeah, sure. Thanks for having me. First of all, our portfolio is very strong. You know, we've been on a journey for the last 3 years, totally reshaping our business, divesting some assets, and really focusing on those categories and brands which are going to drive growth. Obviously, recently added the Hostess business through acquisition. So whether it's pet snacks, cat food, coffee, Uncrustables, and now sweet baked snacks, our portfolio is incredibly well positioned, and our focus on our marketing and sales capabilities and just that blocking and tackling has really helped to drive this growth and give us confidence in the future growth. The consumer, as you highlighted, in some cases is a little bit stressed, but our portfolio is broad and we offer affordable options all the way up to premium options in each of those businesses.
And as you look at Hostess and you sort of work towards finalizing that acquisition, you do plan to significantly increase marketing. You said that at CAGNY last week. Talk us through the pricing strategy for Hostess and how this marketing will help gain new customers to the J.M. Smucker portfolio.
Yeah, first of all, Hostess is a great brand. Obviously, it reaches consumers who are looking for an indulgent occasion during the day. The brand itself is very strong. Pricing is about where it needs to be, and we will step up marketing over time in that brand, as well as continuing to keep that fast cycle innovation that Hostess has been so good at.
And Mark, whenever we think about this company, and I'm so glad to see on the investor relations page, by the way, Uncrustables getting the right shine that they deserve as that header photo, because we know how good the strawberry Uncrustables are. But that aside, the frozen category particularly is always of interest, especially for consumers who are looking to add more shelf life to their purchases as a value hack, as they're being more value conscious. Where do you identify even more perhaps opportunities within that arena?
You know, we're laser focused on Uncrustables. We are now meeting demand. We are producing millions of sandwiches a day. We're about to, in the next year, open our third plant in Alabama to continue to meet the demand. So we are focusing first and foremost on peanut butter and jelly, peanut butter and honey, and we'll be bringing new flavors and executions to bear. We have a reduced sugar option as well. So there's so much runway on Uncrustables because it meets so many need states, whether that's the parent on the go, a lot of athletes consume the product, students and universities and K through 12 schools. There's just a tremendous amount of upside for Uncrustables.
Okay, so leaning more on the peanut butter and Uncrustables, does that mean sunsetting or moving away from some of the ham and or the cheese and Uncrustables?
We don't have any of those items now. We did temporarily launch some different formats to test those, and you might recall they were in a different form, a roll-up.
Yes.
They did well, but we found that the runway is really on that soft bread, circular sandwich with the crimp, and so continuing to push out on that form is really where our focus is.
Mark, I'm just looking forward to the Jif and chocolate that's set to come out later on this year. I do want to quickly pick your brain about coffee. We did see coffee margins improve. You did pass along some cost savings in Q3, but saw a slight dip in volume there. How do you view pricing going forward, and can consumers expect to pay less this year for their can of Cafe Bustelo, particularly my mom?
Well, thank you for being a consumer. You know, we did reduce prices on coffee in the last 6 months because the commodity had come down, and our growth trajectory on coffee continues to be driven by K-Cup across all of our brands. Bustelo is double digit. Dunkin' has returned to growth as we've gotten the pricing right, the relative pricing on Dunkin'. And we're now in the liquid coffee space. So we launched multi-serve large bottles of Dunkin', now the #2 brand in the coffee aisle in liquid. And we are bringing out the liquid Bustelo executions in the next several months. So you'll be seeing those on shelf as well.
Ooh, okay. All right. Looking forward to that. J.M. Smucker Company CEO Mark Smucker and Yahoo Finance's Brooke DePalma. Thanks so much for the time this morning.
Thanks so much for having me.
Absolutely. Well, an executive shakeup at Disney this week. The Motion Picture Group's president of production, Sean Bailey, stepping down. This comes while the activist battle continues at the board level. To break this down for us, we've got Yahoo Finance's very own Alexandra Canal here with us in studio. Hey, Ali.
Hey, Brad. Yeah, so Executive Sean Bailey out after 15 years as the president of Disney's Motion Picture Group. Although he's not completely leaving the company, he's going to serve as a producer for a few studio projects. He will be replaced, however, by David Greenbaum. He's going to be stepping into a completely new role of president of live action and 20th Century Studios. So Disney essentially merging the two film divisions here. Greenbaum used to be president of Searchlight Pictures, where he brought several high-profile films to the big screen, including The Shape of Water and Nomadland. But this does come as Disney has been really struggling within its film business, its live action and animation business. Projects like The Haunted Mansion really underperformed, and then you had the live-action Little Mermaid. Although it brought in more than $500 million worldwide, it still didn't deliver the results that Disney was really expecting there. And this has been called out by both activist investors that are pushing for board seats at Disney, Blackwell's Capital, and Nelson Peltz. So Disney has been really focused on bringing back the creativity, making sure that it's doing as much as it can do to really bolster its film division. CEO Bob Iger has talked about this several times on earnings calls, several times in shareholder letters. Disney just recently wrote another letter to shareholders, really pushing back on a lot of these activist investors and encouraging people to vote for their current board, saying that any deviation from the current board is going to really set Disney back when it comes to its progress. So overall, the company is just going through a bit of turmoil right now. And this is something that Bob Iger really seems to want to address in 2024. We'll see if some of these other projects that Disney has coming out can deliver on the film side.
Yeah, Ali, it's really interesting here in terms of what they're refuting with the claims. They went through 9 examples of where they did dispute some of the claims that were made here from Peltz and from Blackwell. I'm curious, though, since you talk to so many analysts, industry executives within the media space, how are they, maybe this is more so the analyst side of it, how are they thinking about this upcoming vote in terms of whether or not Disney, because I think Disney obviously very much was really seen as being able to fend off some of this pressure from Peltz. Is that still the case?
From the analysts that I've spoken with, yes, that is still the case. Largely, this has been seen as a distraction for Disney, a distraction for Iger. I think if Nelson Peltz was able to get a board seat or Blackwell's Capital was able to push through, that would be a big surprise to analysts, to investors. It is largely expected that the current board is going to remain intact. But, there's a lot of media stories out there. We're constantly getting updates. And it does, I think, if you're an investor of this company, make you pause and think, okay, is Disney on the right path right now? And Disney has done everything I think that it can do to really try and fend off that noise. But again, largely analysts have said this is a distraction. We'll see. April 3rd is when that shareholder meeting will take place, and that's when we're going to get a lot of these answers. But for now, it seems like Bob Iger's really committed to just maintaining the company's integrity. We have the dividend, we have the stock buyback that they announced. So a lot of new initiatives that they're committing to as well.
All right, all the news on the House of Mouse. Ali, thanks so much for breaking it down.
Of course.
Appreciate it. Guys, coming up, single stock call option volumes, they're on the rise. For how you can cash into the trade, we've got the discussion on that next. AI mania is leading to some highly bullish views on single stocks, expressed through the options market, where calls are increasingly outnumbering puts by a factor of 1.75 to 1, a historically high ratio. Here to break down what this means for investors is Jessica Inskip, Options Play Education Product Director, and Yahoo Finance's Jared Blickery. Take it away.
Thank you, Brad. Jessica, great to have you here once more. We're going to get into some trades in a second, but I wanted to start with this chart. This goes back to 2015, and it shows the volume of call options versus put options. And we're seeing a lot of call options right now, not anything near what we saw in 2021 around GameStop, but just give me your thoughts on where we are in the environment right now.
Yeah, just like we pull consumer sentiment numbers, that actually, I believe, came out today.
Yes, a little bit of disappointment.
Yeah, but options can give us also another view, which is a little more specified or niche down. So this is telling me that there's still positive speculation within those options traders specifically. So it's an indication of bullishness within that specific niche of traders.
Well, and bullishness is what we've been seeing in the market lately. Just want to review real quickly for our viewers, because this is an educational segment, calls and puts. You can buy a call, you can buy a put, you can also write it or sell it. And this expresses different views, bullish or bearish.
That's right, yep. And you can be on the short side, so selling and be bullish. So if you have an obligation to buy, and the quick way to remember this is anything that contains a buy, obligation, or right to execute is bullish, a sell is bearish.
All right, buy bullish, love it. All right, here is a trade we're looking at. We're calling this a new segment, Trade with Congress. Palo Alto Networks was in the news yesterday. Here we're talking about a trade getting into it, but this is a very interesting way. You're buying a deep out of the money. That is, the strike price is much lower than the current price, all the way down at 200. Why this number and why this trade?
Yeah, so very deep in the money. So very, very deep. So Palo Alto right now is around 316. This is a 200 strike. So a long call represents the right to buy 100 shares of Palo Alto at $200 a share. If it's at 315, that means it's at least $115 of intrinsic value. Anything of excess is that extrinsic value component that you have to overcome. But something happens when a stock or an option is very, very deep in the money. It starts acting like the stock.
So you don't have to worry about that theta decay because you're not overpaying for that premium.
Exactly, and this is very long dated. So this was Miss Nancy Pelosi's trade yesterday, the January 17th, 2025. But it's a way that options can utilize leverage to still have that long stock exposure, but not have that major theta decay. And that's essentially what this is. This is considerably cheaper in terms of price in comparison to buying 100 shares of Palo Alto.
Very interesting. Now we want to get into a little bit more of a complex trade, but this is simply a cash secured put. This is an option strategy where an investor sells a put option while setting aside the cash to buy the underlying stock if the investor is assigned. And we want to get into the trade, so we're just going to have to skip past these pros and cons. And here is the Apple cash covered put chart. You're looking at a strike price of 180. Can you break this down for us?
Yeah, so the long call, we're speculative. We are expecting a large upward or sharp directional movement. With this, a good contender for this type of security is something that's range bound, or you're waiting for it to break out. You don't expect it to go too high. So instead of we having the right to buy, we have the obligation to buy. So we're selling a put. We want it closest to the money as possible. So which means the current strike, the current market price, 180, about a 45 days until expiration. This one's about 39. What we do here is we actually keep all of the upfront premium, which is about 343, but now time's working in our favor, but we have the same risk as owning the stock.
Which is the price could go to zero.
It could go to zero, but that's what would happen. We do this to actually utilize the obligation found within the short put in order to buy the shares of Apple. That's completely the intent. And in comparison of buying it at 180, you actually get it at a discount at 343.
There you go. We got a little bit of time left, and we're just talking about some of the pros and cons in options trading. But I want to tie it back to the current operating environment, back to what we were talking about in the beginning. We're seeing a lot of bullish frenzy, well, a little bit of frenzy. What do you think, when you're scanning for options, when you're looking for trades each day, what is going through your head to filter them?
Yeah, so it always starts, you have to understand an option as a derivative. So it is derived from the underlying security. So we have to know what our investment thesis is for that underlying stock. Is it an earnings play? Is it something that we're looking for momentum? Or is it something that we want to add to our longer term portfolio? And these were two examples of longer term trades based on the stock perspective. But that's when time and implied volatility comes into play, and you have to know the positive and negative factors, which we touched on.
Yes. Yeah. A very comprehensive interview here. So thank you. Thank you for stopping by, Jessica Inskip, the Options Play Education Product Director, and we're sending it back to you.
Roadblocks ahead for a mega merger. The Federal Trade Commission is suing to block Kroger's $24.6 billion acquisition of Albertsons. The FTC believes that the deal would cause grocery price hikes for many Americans. Kroger responding that the blocking of the merger will actually harm America's consumers and workers. For more on the lawsuit, we're joined by Bill Kovacic, who served as the FTC chairman from 2008 until 2009, alongside Mozelle Thompson, former FTC commissioner who served from 1997 to 2003. Great to have both of you here on the morning to discuss this. First, Bill, I want to go to you on this matter. As you think about what the FTC is looking for here and the arguments that are going to have to be put forward by both Kroger and Albertsons, what are you anticipating?
The FTC has gathered a considerable amount of evidence that's presented in their complaint that in a variety of geographic areas, this transaction is going to create substantial concentration in a market consisting of traditional supermarkets. I think to some extent, Kroger and Albertson will contest that and say that there are retail possibilities that are being left aside, but I think they realize that as a matter of traditional analysis, that they have a problem there. They've tried to solve it by offering a package of divestitures that includes over 400 retail outlets. A core issue in the case is going to be the adequacy of that solution. The FTC says it's not adequate. It's not going to provide robust competition. I think the key substantive issue in the case will be how good is the divestiture package, and is C&S Wholesale, the buyer, going to be an effective purchaser and operator of those assets?
Mozelle, what do you think of the FTC's argument and whether or not, from what we know at this point, if it has a strong case?
The traditional criteria they're using, I think, create a solid case on the question of whether we're going to see increased concentration in the market. The companies recognize this, and again, the real issue is, have they come up with a solution that's going to be sufficient? The FTC also, to an extent that it has not done before, has highlighted the effect of the transaction on workers. A key argument that the FTC is making is that the deal is not just bad for consumers, it's bad for the employees of the two companies. And again, to an unprecedented degree, the FTC is saying that that is a major area of harm from the transaction. And I suspect that as well is going to be a focus of on the discussion of the adequacy of the divestiture. So more than we've seen before, the FTC is emphasizing the adverse effect on workers.
Mozelle, do you agree?
Yeah. Well, yes, but I also would say that you have to look at what the market definition is here. One of the things that Kroger and Albertsons are going to argue is that the people who provide groceries, that market is much bigger than the FTC may actually claim it is. That they say that there are some benefits from them being at a scale where they can compete with entrants like Costco and entrants like Walmart, who are major grocery chains now. And there are also companies like CVS and Walgreens who are also selling groceries, and Target. So they would argue that the market is much broader. But I do think, as Bill points out, they've made major concessions here. The question is whether those concessions will be viewed as adequate.
Mozelle, what
in addition, the FTC is embarking on a test of its new merger guidelines, and that includes, as Bill mentioned, the impact on labor markets, which is a little bit a broader view of competition than has traditionally been there. I don't know how much the courts will look at that and adopt it or not. That's a new area.
Well, Mozelle, to expand on that even just a little bit more, I guess from what we know in this case, and at least the FTC's argument up until this point, what does that tell us even more just about the approach or the landscape here for mergers under the Biden administration?
Well, one of the things that's happened is that they've sent a clear message that mergers will be looked at more carefully, and with a broader approach, looking at an array of different possible impacts. And I think that the test of those impacts are going to be weighed by courts. So far, they haven't had great success, but they're still whittling away at it. And I think this is what they're doing, and also the Department of Justice. What it also says to investors is that deals may still get through, but it will be more expensive and take more time. And to the extent that the Biden administration wants to send a signal that that may give a chilling effect to mergers, that's something that has definitely happened, and the market is responding to that.
And Bill, coming back to you, is Capital One Discover in a separate conversation one of those deals that we anticipate could or should go through from your perspective?
I think this is one that's going to get a very close look and could well elicit a challenge. To go back to Moselle's point, part of the Biden administration's program here is premised on the idea that merger policy going back over a 40-year period was far too permissive in major sectors such as financial services. And from both ends of Pennsylvania Avenue, from the White House and from the Congress, we see demands that the competition regulators and the Department of the Treasury bear down on exactly this kind of merger. All of that points in the direction not only of a close review, but one can imagine a challenge as well. That is, the atmosphere supporting intervention is very strong here.
And Moselle, to expand on Bill's point even more, just beyond that, just the impact that this is going to have on investors, or how investors should potentially view these latest actions from the FTC.
Well, I think what it means is that the antitrust climate is going to be tough. And I think that people who are looking to merge are going to have to not only look at the timing of those mergers, but be able to come up with some real benefits and to show that, and I think the deals will take place, but only the best deals and only the ones that are willing to withstand scrutiny and to take the time necessary for the review to take place. Now, in Capital One Discover, there are a lot of people with their fingers in the pie. They're the financial regulators who look at safety and soundness, but there are also the antitrust regulators to look at impact on consumers. And I think what you also have here is a couple of different apples and oranges. Not only people, the thing that you see off the bat is major issues of credit cards. But don't forget that Discover also has its own network that actually has a relationship with merchants. That, in combination with a credit card provider like Capital One, puts them in a unique position in the competitive landscape.
And some of what you guys are saying is very similar in terms of the atmosphere supporting intervention at this point in time. But that also creates a risk of, like we saw with the banking crisis last year, waiting for companies to be so distressed to the point where it's only some of the largest players that can then have the balance sheets to be able to swoop in and save them. What does that have as a broader economic impact as well? Moselle, I'll go to you on that one first.
Well, I think that that's one of the things that the financial regulators are going to be looking at, because this is a mega transaction, but it looks a little different than the traditional banking transaction. And because of that, they're going to look at how it's going to impact people who use the banking services of these entities. That's a little bit of a review that is not particularly transparent, that not many people in the public look at very often. But it will also be very interesting to new entrants who provide certain kinds of services, whether it's PayPal or other kinds of payment services, and whether this transaction will essentially block them from being competitive.
Bill, I want to offer one last thought to you on that.
I agree with Moselle's assessment. I think that it's useful to keep in mind, again, the overall philosophy that the agencies and the administration bring to these matters. And in looking back at earlier crises, there's a strong belief that it was the fact of too few players in the market, too little competition, too much consolidation that painted the country into a corner. That all creates a presumption that deep consolidations of this kind are problematic.
Bill Kovacic, and also former FTC chairman, and Moselle Thompson, former FTC commissioner. Thank you both so much for your time here this morning.
Thank you for having us.
Good to see you.
You too. All right, well, coming up, what airline trends do you have to be aware of ahead of peak travel season? We've got you covered. Yahoo Finance's Travel Guide 2024 Industry Insights next.
Is 2024 set to be the year airline stocks get grounded? Fuel costs, consolidation, and new routes are all at the center of the conversation. Boeing recently made headlines again, bringing the question of air safety back to the fore. Then there are regular concerns for the sector, from geopolitical instability to the level of demand from the world's second biggest economy. There are bright spots amid the risks, of course. Some major airports are upgrading, and the expectations for demand seem to only climb higher. So how are you spending? Where are you going? And how does the sector perform from here? Yahoo Finance's Travel Guide 2024 Industry Insights has your captain speaking and asking the question, what's next for airlines?
What is next indeed? We're going into the 3 things that consumers should be watching in the airline space this year. Joining now as part of Yahoo Finance's Travel Guide 2024 Industry Insights, our very own Pras Subramanian. Pras, we've got some more bad news for Boeing yesterday. We don't have it, but we got it from them.
You know, the topic on everyone's mind is Boeing, right? A new FAA report on Boeing safety culture came out, and they said, quote, they found gaps in Boeing's safety journey and described the safety culture as inadequate and confusing. Not all employees understood the reporting process for reporting problems. There was retaliation for workers who spoke up in some instances. So, and this report was actually written before the Alaska Airlines blowout. So it's sort of kind of indicating there's still more issues that Boeing needs to deal with, more work to do in the future for them.
Perhaps a lot of concern about Boeing planes being grounded for some time is how that's going to impact the supply that's out there, how that could ultimately impact airfare prices. What have we seen so far, and what are we expecting to see as we head into the very busy travel season?
Yeah, you know, when some of those 737 MAX 9s were grounded, we saw some disruptions there and some travel issues there and probably some price hikes because planes taken off out of supply. But according to Hopper, they're seeing that fares are actually, for the spring travel boom, down 2% compared to last year and a whopping 11% compared to 2019 pre-pandemic levels. For European long-haul flights, down 7% compared to last year and 8% compared to pre-pandemic. And they think that in the next 6 months, domestic flights will stay below 2023 trends and also below the pre-pandemic kind of high there. So good news for travelers there from an airfare point of view.
And one of the other things that we've heard from CEOs this earnings season on the airline front is about the international travel demand that they're seeing right now, and specifically China's travel rebound. Can we expect that to pick up this year?
You know, they were later than most other countries in opening up and returning to travel, and many in the travel industry expecting a China boom to launch that. And we're seeing that Chinese authorities anticipate air travel to recover there. HSBC, in a note about Asia, said that China's outbound travel to Southeast Asia is booming because there's visa-free travel there. That's helping there despite macro headwinds, they say. We believe Chinese citizens will still be willing to spend on travel-related experiences. Also, JPM with a note out talking about how returning travel will help Macau in gaming, so that'll help these hospitality and casino operators in Macau too.
All right, Pras, thanks so much for breaking that down for us. Let's continue the travel conversation. Airline stocks are taking flight just a bit so far in 2024. We want to take a look at shares of Delta, United, American Airlines, all gaining year to date. You can see, though, not much of an uplift here since the start of the year. Now, as we approach the very busy spring travel season of the year, what stocks are best positioned? Joining us now as part of Yahoo Finance's Travel Guide 2024 Industry Insights, we have Helene Becker, TD Cowen, Managing Director, and Steve Trent, Citi Managing Director. Steve, let me start with you. In terms of how airlines are positioned ahead of the rest of the year, from your view, are we going to see more of that recovery take place, and who do you think has that lead position?
Yeah, absolutely, and thank you for having me. So I do think that the network airlines look better positioned. We continue to have generally to very good demand trends, not only talking about ticket revenue, but all the ancillary stuff they do. Co-branded card, loyalty program revenue, international capillarity is still a very good place to be. You know, the discount airlines that are mostly US based, we're a little less sanguine on those in terms of what opportunities we see. But overall, the picture looks good from a capacity perspective. So 2019, we had $23 of US economic activity per available seat mile. We last year finished around $28. So the pie itself looks very good. We think that distribution of the economics could be tilted toward the network airlines.
Helene, want to bring you into this as well. I mean, when you think about the international exposure that airlines need to have in order to be among your top picks, how important is that international demand into this year's performance that trickles through to what investors are going to be watching in the stock price action?
Well, I think in terms of international, we're seeing pretty strong demand. The airlines, though, have adjusted capacity lower since we initially cautioned back in December that we thought airfares internationally would come down this summer because capacity was rushing into the market, and not so much from U.S. carriers, but from international carriers that didn't have the ability to add capacity last summer. So, for example, Lufthansa is up 16% this summer versus last year, while United is just reinstating seasonal service, and their capacity is actually up low single digits.
Steve, what do you think the pricing power looks like from these airlines, and how much higher some of those airfares could potentially go?
Yeah, so I think relative to last year, the year before, relative to 2019, it's possible that we won't see them as high as they've been over the last year and a half, but a fair bit of that is coming down to oil prices. So we did, of course, have a lot of pressure from jet fuel prices, 2022 and into 2023. So some of that moderation should be related to fuel. But when we think about this from an ex-fuel perspective, we do think there should be stability to even some upside in fares. As Helene mentioned, we do have some capacity constraints. We have the powder metal alloy contamination on GTF engines. Boeing's had some issues. So it's possible that elements of the market won't have as much equipment at the end of the year that they're expecting to have today, and that could support pricing.
Just to follow on that, does that mean any material reduction in route schedules that the airline operators are flying right now?
Yeah, it could be, depending on which ones. I think regional airlines kind of come to mind in terms of where we could continue to see some scarcity of equipment. I think in pockets, yes. And then you also have markets that over the last 3 years have been hot, like South Florida, where everybody put metal into that market during the pandemic. Now probably you see some rotation out of those regions.
Helene, one of the things that we've continued to hear from airline CEOs is just when they expect to take delivery of some of these new aircraft and add that into the fleet. How would you be evaluating that, and when that could actually be a pass-through, a boon for some of these businesses as well?
Yeah, the way we think about it is everything slides to the right. So if an airline tells us they're expecting to take delivery of 50 or 60 aircraft this year, we probably think they'll be closer to 40 aircraft because of the delivery delays, the supply chain issues. And we think that we'll probably see some lease extensions into 2025 to cover some of the gaps because of all the delivery issues that we're seeing in the OEM problems. And so that's how we think about it. We kind of push everything off to the right, which is really helpful. Our hope is that the government doesn't shut down because the FAA reauthorization expires March 8th. It was punted to early March, which is just 2 weeks away. And we need, or next Friday, I guess, March 8th. And we just need to have continuity in that regard. Because if we don't, air travel is going to get worse than it already is. I don't think anybody would give airlines really high marks for the service that they deliver. And without the support network of the government, air traffic control, even the OEM, the suppliers for maintenance, without their support, air ticket prices were going a lot higher over time because demand isn't going down, and yet the supply, the number of seats available, is going down, or at least is not keeping pace. So we view that as concerning because it will eventually, if fares get too high, people will opt out, especially in the domestic market.
And see, we're also getting some developments on the JetBlue Spirit saga that's playing out yesterday, urging the U.S. Appeals Court to allow the merger to go forward. What's your assessment of that risk? Or I guess, is it more of a short-term risk? And how do you see this ultimately impacting the industry at large?
Yeah, certainly I think right now it's a very difficult time in the aviation industry for any M&A to get done, at least over the short term. So we know there's some other stuff out there that's cooking that might be less controversial than what JetBlue's trying to do. But when we look at this particular case and the business model differences and the government's desire to preserve maverick pricing carriers, for example, it looks like it's going to be a difficult road. And possibly, the airline industry could use a little bit of consolidation. So does that come through M&A? Does it come through carriers doing filings or what have you? I hope it's not going to be the latter. But we think one way or the other, we could see on some level capacity continue to come out of the industry, at least over the short term. Whether that's M&A or, as Helene mentioned, we get ongoing delays from the OEMs.
Two of my favorite airline analysts here with us on Yahoo Finance today, Helene Becker and Steve Trent. Thank you so much for taking the time here today. Appreciate it. Time now for a quick check of the markets as we wrap up today's show. The first 90 minutes of trade have the Dow down by about 0.3%. The S&P 500 and the NASDAQ, though, holding on to gains right now. The S&P by the hair of its chinny chin chin up by about 0.02%. And the NASDAQ, you're seeing gains there of about 0.2%. So we'll continue to watch that as we get closer. Well, we've got a ways to go. We're not getting close to the end of today's trading session. Anyway, it's all relative. We'll see you tomorrow.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Akiko Fujita. Here's what I'm watching at this hour. The return of the crypto bulls. Bitcoin tops $57,000 for the first time in more than 2 years. MicroStrategy's big buy-in, the big catalyst. Retail turnaround. Macy's announces plans to close 150 stores as it looks to reduce the footprint of its outlets. What the new focus on going smaller means for the shopping experience. And retirement millionaires. A hot stock market pushes retirement accounts to new heights. We'll discuss the steps you should take to maximize those gains. That is all coming up later in the show. But first, let's take a look at where markets are trading. 90 minutes into the trading day, a bit of a split picture here, but we are seeing the Dow down 122 points, the S&P 500 trading flat, and the Nasdaq up 36 points. Some economic data coming through this morning that points to some steam potentially coming out of the economy. We got durable goods orders posting the largest drop in nearly 4 years. And then, of course, the Conference Board's Consumer Confidence Index falling for the first time in 4 months. Let's take a look at where Treasury yields are trading on the back of that. And we have seen them all, aside from the 30-year yield pushing lower, the 10-year yield at 4.3% and the 30-year yield at 4.42. The top story we are watching today, though, is Bitcoin, the cryptocurrency hovering near 2-year highs as the rally picks up steam, spurred by investor demand in the new spot Bitcoin ETF, as well as a big buy from MicroStrategy. We have our very own Jared Blickery tracking the latest crypto moves, and we got some bullish calls already coming through. Jared, about where this could all track.
You bet. There's going to be no shortage of those calls if and when we do take out the highs. But let's take a look at some of the charts. This is the day that Bitcoin has made up 7.5%. Here's the 3-year chart. Here are the all-time highs. And I'll put a line chart so you can maybe see a little bit better here. But there is not a lot of way standing in between this market and record highs. And just based on the momentum that we've seen over the last month, look at this, up 35%. Looks like it wants to get there sooner rather than later. Don't want to get too ahead of ourselves. There's a lot of work to be done. But here's Ethereum up to $3,231. You can see very close to the midpoint in its record highs with respect to them. That is up 121% over the last 3 years, but still got a little bit more work. And then I was checking out some of the other tokens. Here's Solana. I was going over this setup yesterday. It has yet to break out to the upside, so there might be a laggard play there. I'm not saying that it will get to its record highs as quickly as some of the others, if and when that happens, but something to look at. Now, here's another market. Here's Dogecoin. You can see still mired in the bottom end of its range relative to its highs, all-time highs a few years ago. You take a look at the 2-year chart, very much range-bound and sideways. Nevertheless, it's up 11% today. It's hard for me to think that it's going to get up to its record highs anytime soon, but anything is possible. Now, we also want to check out crypto stocks because check out the 5-day action. A lot of these up over 20%. Here we have MicroStrategy, Sailor's Firm up 22% over the last 2 days. It has exploded to the upside. And just take a look at this 5-year chart. You can see very similar to Bitcoin here. It's actually a more levered play, so a little bit more risk there. But its record highs definitely in sights there. And I was also checking out a couple others. Let's check out Coinbase because this is a stock that top-ticked Bitcoin and the entire crypto rally a few years ago. It is coming back and it is catching up nicely. And maybe we got time for one more here. Here's Square, here's Block, not the most relevant to blockchain, but still a big part of its network. And there you go, kind of in the bottom end. So I think we got some winners here, some potential losers, but the winners by far outnumbering those that are left behind.
Okay, we're going to be talking a lot more about those moves later on in the show. Jared Blickery, thanks so much for that. Well, retail results out this morning for Macy's and Lowe's. Both stocks surging as they beat expectations in their latest quarters, despite seeing sales fall. We also got a somewhat downbeat report from the Conference Board, Consumer Confidence, falling to 106.7 in February. That is from a revised 110.9 in January. Joining us now on this is Sucharita Kodali, Forrester Research retail analyst. Good to talk to you today. Let's start with Macy's because we are seeing that stock up in a big way, nearly 4%. What did you like based on the results we got?
Well, Macy's exceeded expectations, but the numbers by no stretch of the imagination were wonderful. The sales for the last several quarters had been down in the mid-single digits, and this past quarter, I think, was perceived positively because it was down, but only in the very, very low single digits. Some of the things that actually concern me are that its digital sales numbers were down lower than its bricks and mortar numbers. That is unheard of. Typically in retail, everyone's digital sales numbers are stronger. But for them to have softer digital sales in a world where more shoppers are consuming through e-commerce suggests to me that they may be losing disproportionately a lot of market share. And certainly as they are closing 150 stores over the next several years, that some of that market share presence, that story doesn't look great when you look ahead.
Yeah, it doesn't look great. And as you point out, I mean, this is a company that is still trying to find the right turnaround mix, right? We are seeing the company close those Macy's stores. They're trying to focus more on the high end with Bloomingdale's as well as Bluemercury. What does that mean for the Macy's brand?
Well, I think that the Macy's brand ends up being some of the really, really premium flagship locations. I think that they're going to try to hold on to the Herald Square store for the sake of their balance sheet. Hopefully they're able to hold on to it, but they may end up doing some sort of a sale leaseback and unlocking some of the cash that is in that store. So certainly there is some real estate that is really the big asset that Macy's has. But your point is a good one, which is that they do seem to be diversifying to these other brands. So they're opening nearly as many Bluemercury stores as they're closing Macy's stores. So Bluemercury is often in some of the newer malls. It's in higher foot traffic locations. And it's good margin because it's beauty products, but it's a small store, and each individual location is not going to make up for what they're probably losing from a top line from the closure of a Macy's store. So I think really it's becoming a smaller company. But the hope is that the profitability story improves by investing in high-end luxury with Bloomingdale's and beauty with Bluemercury.
Sucharita, with Macy's specifically, though, I mean, it feels like the company is moving away from the large department stores we know Macy's to have to a smaller footprint. Is that where retail is going? Is that the right strategy here? When you consider what you pointed out, they're not even getting the bump in digital right now.
Right. Well, I don't think that it's the story. It's a great story in the department store sector, and it's not a great story for a lot of mall merchants to have these large physical footprints, especially because in many of Macy's categories like apparel, footwear, more and more of their shares of sales are migrating to e-commerce and the web anyway. But that's not to say that every large store is suffering. I mean, you look at the warehouse club sector, it's doing very well. Mass merchants like Walmart and Target are generally doing very well. There are large box stores that are continuing to grow, like Tractor Supply. So I don't think that the story of large box is a bad one. But keep in mind, all of those companies that I just mentioned, none of them really have presence in the indoor malls that Macy's is in.
Let's talk about the companies you do like: Walmart, Amazon, Costco, another one. Is it about sort of staying in the grocery lane right now, or more diversified retailers in this environment where we're seeing more and more that consumers are being a little more discriminatory in how they dole out some of their discretionary spending?
Yeah, the consumer is spending in very specific categories now. So certainly food is one. The mass merchandise sector is another, with a lot of consumables. Beauty and health are actually doing pretty well. When you look at even Walmart, some of their strongest numbers are in their health and wellness segment. So that's a sector that is absolutely resilient. And that's also, interestingly, arguably part of, kind of some of the bright spots in the Macy's portfolio is where some of the Bluemercury numbers are. So there are places where consumers are spending. Consumers are also spending a lot at food away from home, which is the restaurant sector. That's been disproportionately positively affected and has been growing incredibly strongly in the last several years. So there are places where, in spite of lower consumer confidence, the shopper is still spending. And some of those brands that we did talk about that are doing well are certainly leveraging some of the success in grocery in recent months, but are also just the places where consumers often trade to if they are feeling economically pinched. So that's part of it too. Those are often recession-proof businesses like a Walmart or an Amazon or a Costco, because people go there when times are good. People go there when times are not so good.
Finally, we did get the Consumer Confidence Index today, that falling after 3 straight months of gains. Economic data seems to point to the fact that things are pretty resilient, and yet consumers aren't necessarily feeling that great. What do you think's going on?
This has been an issue for months now, where the consumer says one thing and has been doing something different. And the consumer confidence numbers, when you dig into who is particularly distressed or who is perceiving that perhaps the economy is in worse shape, some of it is politically aligned. Some of it is younger consumers that may be taking on more expenses, like paying back student loans. Some of it may be the consumers that are not that are either unemployed or have experienced some hardships in transitioning to other employment opportunities. So there are sectors that certainly are expressing dismay, and that I think is dragging down some of those consumer confidence numbers. But when you look at the overall levels of shopper spend, those levels are incredibly high, and they're much higher than 2019 levels. And I think that it's very, very difficult to reconcile, well, if people are so distressed, why is it that they're spending as much? And it suggests that maybe there are a lot of people that are not that distressed, because wages are at an all-time high, and overall unemployment is relatively low, and the labor market is tight.
Sucharita Kodali, Forrester Research retail analyst. Always good to get your insight. Thanks so much for joining us today.
Thank you, Akiko.
All your markets action ahead. Stay tuned. You're watching Yahoo Finance. Markets are mixed ahead of the Fed's favorite inflation gauge, or preferred inflation gauge, PCE, out later this week. Investors hoping inflation will come closer to that 2% target, which could mean rate cuts up ahead. But our next guest thinks investors need to unwind their rate cut expectations and prepare themselves for a no landing outcome. To break it all down for us, we've got Philip Kolmar, MRB Partners Global Strategist. Phil, it's good to talk to you today. I want to pick up on the point our previous guest, Sucharita Kodali, was making about the consumer confidence index we got today, suggesting that, look, on the one hand, consumers may say they don't feel great about the economy, but the data doesn't necessarily support that. There's a bit of a disconnect. How do you look at that?
There's been a disconnect actually on the consumer side and on business confidence, if you will, really over the past couple of years. So if you ask consumers, what do they think ahead? If you think of the year ahead or the economy situation looking out, they tend to be quite pessimistic. And this has been a sort of a false signal for a lot of those economists looking for recession repeatedly over the last 2 years. While they look pessimistic going forward, if you ask them about what do you think about your current situation? What do you think about your current job market? What do you think about your current balance sheet? Those kind of items. Are you willing to spend? They're much more optimistic. So you're seeing that big present situation gap versus the expectations. And the expectations has been incredibly misleading, whereas present situation is quite upbeat. And that's been tracking with more spending numbers. The same is true for businesses. If you ask them about the future of the economy, it tends to be quite pessimistic. This is really something we've seen post-pandemic. It's maybe the news flow is very pessimistic, maybe see uncertainty in the background, all that kind of stuff. But if you ask them about their current operations as is, and what they look for in their current business models or the coming quarter, they're much more constructive on things. And then they continue to keep the job engine going. So I think there is this disconnect. You got to be real careful with that. And unfortunately, a lot of economists like to look to the forward-looking components as their lead on the economy, and it's just been misleading.
Let's talk about what's been playing out on the markets. I mean, certainly you could argue there's been a lot of optimism, at least around tech and AI, given the rally we got last week. A bit of a pause, at least a breather so far in the sessions this week. But you have said that you think the market is getting too far ahead of itself, that there needs to be a bit of an unwind. What do you mean by that?
So I think there's two elements to the theme. The core theme of this year was that I think people, and you opened with a session, that people were betting on that soft landing scenario. So in that soft landing scenario is where you're going to get subdued growth enough to bring down or build enough slack to bring down inflation and get deep Fed rate cuts. Unfortunately, the soft landing was probably in place, according to all of our research, before the Fed pivoted. So the pivot and the bringing down of bond yields and stuff coming into the beginning of this year provided an extra shot of monetary conditions easing, if you will. And that's leading to so-called no landing or even a liftoff sort of scenario in the economy. And by no landing, I just mean we're not going to go below trend. So it doesn't allow for that slack to build up. It leads to stickier inflation prints. And so in that, it's not so bad because there's no landing scenario is good for cyclical stocks and it's good for the risk on rally in general. The caveat to it is that it also doesn't lend way to those deep Fed rate cuts, and it means higher and for a longer bond yield environment. And so when you're looking at a higher for a longer bond yield environment, you kind of want to be in places where the earnings bars are a bit lower, valuation support is going with you. And those tech stocks, that's the other part of it, they, in the beloved parts of the market, the Magnificent Seven, if you will, they've had a sharp rally. But right now, they have very elevated, not only valuations, so they don't offer a lot of valuation support, but they have really astronomically high forward earnings estimates. And when I say that, I mean, if you look at the tech sector on a multi-year basis, a long year forecast of earnings, it's the highest we've seen since the late end of the dot-com bubble in the 1990s. So the earnings bar is high, the evaluation's there, and they need to meet it. There can't be any kind of question by investors or the consensus about the so-called moat around their business models and the idea of increased competitions or revenues continuing to generate there.
And Phil, just to clarify, in your no landing scenario, does the Fed still move ahead with a rate cut, at least one or two?
We've been pretty clear that there's no real economic foundation to have any kind of rate cut. That being said, the Fed seems determined to provide it. There will be some uncertainty with the inflation data in the near run. They'll probably give a window. So we actually think the Fed, even though there's not an economic foundation in our opinion for it, we think that they'll probably try to do 50 basis points. But the idea of doing deeper Fed rate cuts and then more into 2025 that the bond market has tried to gravitate towards has got to come out. So it's already partially unwound now, but it'll continue to unwind. So you'll get a rate cut, which we would explain as sort of misstep by the Fed, thinking that inflation's softer. There's no part of the risk asset spectrum from equities to cryptos to anything else that's telling you that monetary conditions is tight or that the world's not flush with liquidity right now. So rate cuts isn't really needed. The economy's firing on all cylinders. The job engine's still there. There's really nothing. It's a hope by Powell that there's some kind of disconnect that magically inflation is going to come down regardless of a durable economy, and that 2% is the anchor, which we find misleading. It's not going to settle that low.
And Phil, really quickly before we let you go, in that environment you just described, your top pick, name or sector?
So the top picks away from tech, but it's going to be into we like aerospace and defense. We like energy after being beaten up last year. We do like your mega cap financials, and if you want to augment it with a defensive, we like healthcare, which is less of a bond proxy. So we find value there.
Philip Kolmar, MRB Partners, a global strategist. Good to talk to you today.
Thank you for having me.
Coming up, Bitcoin bulls on a rampage. Prices reaching a 2-year high, but can the momentum last? We'll have one analyst reaction on the other side. We'll be right back. Well, the price of Bitcoin reaching its highest level since November 2021, briefly pushing past that $57,000 mark. The big catalyst this time, a big investment from MicroStrategy. Bitcoin miners and crypto exchanges, including Coinbase and Robinhood, are also seeing gains alongside the leading digital currency. So, Can Bitcoin bulls expect more upside in the months to come? For more on the crypto market, let's bring in Owen Lau, Oppenheimer Executive Director and Senior Analyst. Owen, we're talking about this big buy from MicroStrategy as one catalyst, at least today, but is it really at the end of the day about the Bitcoin ETFs and having the easier access?
Yeah, so first of all, thank you for having me. You are definitely right. Yesterday, we saw the news from MicroStrategy buying 3,000 Bitcoin for $155 million. And I think that was part of the reason why the Bitcoin kind of breaks through that $52,000 range. And going forward, I think going into April and maybe even May, we're going to see the catalyst from Bitcoin halving and the catalyst of further adoption from spot Bitcoin ETF continues. When we track the numbers, we continue to see more and more new money coming into these products in IBIT, in BlackRock, and also Fidelity. So I think the trend could continue, but just be mindful that there may be sell the news event in April.
Is that all just institutional money, as you pointed out, when you say new money flowing in?
Yeah, so I think it's a little bit of everywhere. Some institutional monies, I think most of that. If you're retail investors, you have the access to Coinbase and Robinhood and some other platform already. So I would say most of these monies are coming from institutional investors. But this is against the backdrop that, remember, many of these financial advisors and RIAs, they are still doing due diligence. So what we are seeing is there could be potential more money coming into this space once they finish the due diligence and they change the policy.
You know, we always try to make sense of where Bitcoin is moving by seeing where the correlation is with equities. Are we seeing, is this a hedge? I mean, is there anything that we can point to that tracks with where stocks have been moving? Or is it just the general risk-off sentiment we've been seeing in markets broadly?
Yeah, it's hard to gauge. If you run the correlation, it may correlate to high-tech companies, high beta tech stock. Some people view this, or many people view this as a hedge, a digital gold to hedge inflation. The good thing about, interesting thing about Bitcoin is it is just a little bit of everything. But what we saw is if we're going to see rates coming down, Bitcoin should benefit from that. And if we see high tech companies to go up, it also has a high beta characteristic that can also drive Bitcoin up as well. So I would say hard to find one point to gauge Bitcoin because Bitcoin, it's kind of a combination of many things.
Yeah, I should correct myself for saying it's about the risk on sentiment, not necessarily the risk off. You mentioned two key catalysts that we're likely to see within the crypto space. You combine that with what you just mentioned about Fed policy being potentially supportive for Bitcoin to push higher. What does that mean for where prices move? We're at roughly 57,000 right now.
Yeah, I mean, it's again, like, I don't want to predict whether this is going up or down, or do I have any target for Bitcoin, but I do see these catalysts to play out. Again, go back to the catalyst having in April, even spot Ether ETF in May, and also the Bitcoin, the Fed rate cut in the second half of this year. That could potential to support Bitcoin to go up. But again, just be mindful that Bitcoin has been up a lot already. So go back to my previous comment, just be careful about sell the news event in April. It's hard to gauge, tick by tick and daily movement of Bitcoin, but I do think that the backdrop is pretty favorable for this asset class this year.
And Owen, since we're talking about, where Bitcoin is tracking today, you can't help but think about that record that was set back in November of 2021. Is this rally different?
This rally, I feel like this is different because if you look at the last crypto winter, we also had a lot of, I would say, a lot of retail participation. If I look at Coinbase retail trading volume, at the end of in the fourth quarter, if you look at retail trading volume in Coinbase, we are only at 16% of the last peak retail trading volume back in fourth quarter of 2021. So I still see more room to go up. At the same time, I do think we have a lot, wash out a lot of bad actors already. So it just feels different to me because the space is cleaner, and also retail participation is not there yet. So that's why I still see some upward momentum here.
Owen Lau, Oppenheimer Executive Director and Senior Analyst. Good to talk to you today. Appreciate the time.
Thanks a lot.
Well, housing hurdles aren't going away anytime soon. Home buyers grappling with the low supply that has pushed up prices, making buying a home unaffordable for many Americans. Here are 3 things you need to know about the 2024 housing market right now.
The U.S. housing market is facing a trifecta of challenges when it comes to affordability: tight inventory, climbing prices, and elevated mortgage rates. So what does this mean for buyers and sellers? Here are 3 things you need to know about the 2024 housing market. Number 1, inventory. People are staying in their homes longer. Thank you, baby boomers. The lack of homes for sale and high housing costs are just some of the reasons people aren't moving. Sales of previously owned homes hit its worst level in decades last year as elevated rates and rising home prices deadlocked affordability. The demand-supply imbalance will carry into this year. There is a 3.2-month supply of unsold inventory at the current sales pace. For perspective, at least 6 months of inventory is considered a healthy market. Despite the tight inventory in the resale market, the newly built home market remains attractive. New homes accounted for nearly 32% of single-family homes for sale, Redfin reported, marking the highest level of any fourth quarter on record. But inventory is only part of the story. There's also the dilemma with home prices. Number 2, home prices. Buyers beware, but sellers rejoice because home prices have never been higher. The median price for a home is around $361,000, up 5% from the prior year, Redfin reported. The pressure of limited housing supply has kept home prices elevated. Homes were 6.7% less affordable in December on a year-over-year basis, the National Association of Realtors reported. Despite elevated prices, builders were able to take advantage of lean inventories in the resale market and offer buyers incentives, including price cuts. The median sales price of a new home fell 6% from a year ago to $434,000. But it looks like home prices won't be leveling off anytime soon. Data from Wells Fargo projects new home prices to rise 2.2%, while existing homes are estimated to increase 3.1% this year. Number 3, mortgage rates. Another reason for the limited supply of homes has been the lock-in effect. At least 80% of homeowners who hold a mortgage had a rate of 5% or lower nationally in the third quarter of 2023, discouraging homeowners from selling and buying another in today's high interest rate environment. Rates have roughly doubled since the pandemic, thanks in part to the Federal Reserve's fight against inflation. Inflation remains stubborn, leaving rates elevated. Last year, mortgage rates rose above 8% in October, but have now come back down to range around 6%. Data from Freddie Mac shows that the average mortgage rate for a 30-year fixed loan climbed to 6.7% from 6.64% a week prior. Not much reprieve there. By contrast, home builders have been able to win the housing recovery by giving buyers what they want: mortgage rate buydowns. That's when the builder upfronts the cost to lower the rate on the loan, making new construction the place for deals in this housing market. Economists expect the housing recovery to stall over the next few months, given that long-term interest rates have jumped back up again this year. However, the hiatus will likely be short-lived. How will this economic picture play out throughout the rest of 2024? Make sure to stay up to date on the latest developments as Yahoo Finance continues breaking down everything you need to know about the housing market this year.
A new Wells Fargo Money study finds that 2/3 of Americans are cutting back on spending, while just over half are worried about their financial situation, even if they do have enough saved up. For more on that, let's bring in Michael Liersch. He's Wells Fargo Head of Advice and Planning. Michael, good to talk to you today. How does this situation differ from where we've been the years past?
So when we think about how Americans are feeling in our Wells Fargo Money study, the big thing that we understood from them is that they told us that they're more worried and more concerned and feel more constrained than they have been before, especially when they were growing up around money. And that leads into a very set of interesting behaviors, including being compelled to lie about how much they spend, being compelled to even lie about the value of their homes, being really reluctant to talk about money in general. So it's really creating a lot of different behaviors for Americans, this enormous concern they have around their money, which, as we all know, contrasts with some of the economic data we've seen, which is reasonably positive. So Americans, for whatever reason, aren't feeling that in their pocketbooks.
What's driving some of those concerns?
So when we think about what's really driving the concern, it's this idea that after they spend on needs, we had a high number of participants say that they didn't feel like they had a lot to spend on extras. So think about inflation, think about rates or borrowing costs, those types of things putting pressure on Americans and causing them, and many almost have said, to make really tough financial trade-offs and choices on a day-to-day basis. And I'm a behavioral scientist, so what that means is it makes the mind pretty exhausted when you go throughout the day having to make tough economic choices that you may not have had to make in the past 2 or 3 years when inflation was lower or rates were lower.
How does this differ from, within demographics? I mean, I sort of think about Gen Z, those who are in their 20s versus maybe older millennials. I mean, are you seeing a divergence there about the concerns that come from money, the way they think about what the future could hold, specifically on their finances?
Absolutely. So some of the most fascinating data comes from teens. So we were able to actually do what's called the Talk Aloud protocol, to actually talk to teens for a long period of time, as well as include them in the survey. And they are the most worried and anxious when it comes to their money, even relative to, let's say, their adult counterparts in a variety of areas, which is causing them to feel especially compelled to lie, especially when it comes to things like spending and what they're spending on. And so we see in that demographic, the worry and concern is in some cases highest. When we look, though, at young affluent Americans, for example, they seem to really be dealing with the economic dynamics a very, very positive way. So there's a level of optimism in that cohort, and they're continuing on with their life plans, whether it's buying homes or spending money they want. They're just being very, very intentional about that spending and making sure that they really set goals and plan for their future.
So you look at something like the Consumer Confidence Index today, pushing or pulling back for the first time in 3 months or 4 months, I guess, when you consider 3 months of gains. Is that reflective of what you found in your study? Because the question then becomes, well, if the economic data looks pretty positive, then why are Americans so down on the economy and where they are personally?
So when we look at where Americans feel really constrained in our survey, what we find is it really is on the spending patterns and making those tough choices. So if we think back just 2, 3, 4 years ago, when inflation was lower and prices were more predictable, we could almost go on a set it and forget it. And we all hear that in investing context often, or autopilot, or make things automatic. And why we see potentially the sentiment changing is because we can't be on autopilot anymore. Prices are a bit less predictable in terms of what we've been used to. We can't go throughout our day thoughtless. We have to be hyper intentional so that at the end of the day, at the end of the week, at the end of the month, we have enough money to pay for those essentials and also have a little extra left over to spend and to enjoy our lives. The positive part is Americans in our survey looking forward feel a sense of optimism and told us that the majority told us that this idea of ups and downs is a normal course of being an American. And so they're ready to stay positive and to try their best to find solutions. They said they didn't want to talk about problems anymore, solutions to stick to their savings and investing plans.
Michael, I want to get back to what you said about teens and how they are so concerned about where their finances are. I wonder how much of that has to do with sort of the noise that they face every day, whether it's the headlines, whether it's on social media, how much of it has to do with where they have been the last several years as a result of the pandemic. I mean, are there other external factors that you found that really have contributed to those concerns?
So there's three that came up. One is simply how much time we're spending, to your point, on things like social media. So we asked a very basic question: how much time do you spend managing your money per week? And people said around 3 hours on average, versus scrolling social media videos, which was 9 hours per week. So when we think about where we're spending our time and energy, to your point, those social pressures come into play. The second one is this extraordinary sense of self-judgment and also judgment, to your point, from the external environment that teens and frankly adults feel each and every day. And that caused in this third category for people to want to actually have a mental reset. So the majority of Americans wanted a mental reset when it came to their money because they want to take control of their money. They recognized money was taking control of themselves. And so that's where people wanted to stop talking about the problems and talk about the solutions, like how to stick with their savings and investing plan, how to be more intentional when it comes to spending. So that was a really positive turn. And if we're able to help our teens and encourage them to focus on what's in their control versus what's, to your point, out in the environment and out of their control, that puts sometimes those pressures on us to be something that we aren't, we can actually start a national conversation that will help us make more of our money.
Fascinating study there. Michael Liersch, Wells Fargo Head of Advice Planning. Good to talk to you today. Appreciate the time.
Thank you so much.
Well, the number of people with more than $1 million or more in their 401ks has soared, jumping 20% between September and December. That's according to Fidelity Investments. Let's bring in Yahoo Finance's Kerry Hannon to discuss more. Kerry, how much of this is just strictly the result of the market pushing higher?
Well, woohoo, right? Absolutely the market helped. But Akiko, the thing is, these people who became millionaires in their 401k retirement plans have a couple of common things that we can all learn from. Number one, it's a combination of factors, right? First of all, they contributed enough to the retirement accounts to get their employer match. Secondly, they increased their contributions annually, more than just 1% or 2%. And third, they're in it for the long game, right? The average millionaire at Fidelity had 26 years of steady investing. And the average person was 59 years old. So this is like, they're in it for the long game. But again, the final piece of this is, yeah, they're saving, but oh my gosh, they are saving on steroids, right? They set aside on average, 17.5% of their annual income. And with the employer match, that comes to 26.6% savings rate, which compared to most people, the average is about 14% at Fidelity this year. So that's pretty extraordinary. And so you got to go hit the gas, people.
Yeah, I mean, that's how I think a lot of Americans are feeling right now. There's a new study out that points to Americans, though, struggling with financial literacy. What can you tell us more about that?
Yeah, this one really alarmed me. This is from the American College of Financial Services, and they did a survey of people between the ages of 50 and 75. And they flunked. They flunked the quiz. It's a long quiz on Yahoo Finance. We have an abbreviated version of it for people to play with this, but they didn't just flunk it. They got an average score of 31% out of 100. I mean, this is alarming. And so why this is so important, Akiko, is that we absolutely have to know how much we're saving, what we're investing in, how do we withdraw this money? I mean, this is imperative that people ramp up these skills. So this is just not good. There are a couple of caveats. I mean, people who had more socked away in savings, like $1 million, they scored a bit better on the exam. People who had higher education did a little bit better. People who were white did better. And people who were retired did better. But they still all flunked. don't. I mean, this was not, that they were getting A grades on this, even those people. So, what's important here is you've got to know that it's important to understand these costs of living in retirement to help you prepare for retirement. We've got healthcare bills that are going to be quite extraordinary for many people in retirement, and long-term care is something that we really just need to dig into.
Carrie, I'm a little concerned about how I would score in that test, but you can read all about it. Carrie's story on yahoofinance.com. As always, really good advice there. Thanks so much.
Thanks, Akiko.
Well, coming up, why social media may be giving you the wrong tax advice. More of that after the break.
This right here will allow you to file your status. You don't want to freaking pay taxes anymore? This is the form.
If you've got to take that form and exempt yourself from taxes, that's your personal decision. I would go to DuckDuckGo to download that form, and your employer has to accept it no matter what.
You're taking a look at some TikTok posts that have gone viral telling Americans to stop paying taxes by exempting themselves from tax withholdings. The videos wrongly suggest that this will stop taxpayers from paying federal taxes. Here to tell us more on what's going on is Yahoo Finance's Rebecca Chen. And Rebecca, of course, this is just two examples of some of these sort of videos that have been circulating on TikTok, really suggesting the wrong advice here at the height of tax season.
And that's right. During our reporting for the tax season, we came upon these videos that are suggesting Americans to stop paying taxes by not having any withholding. And some videos even suggest that if you don't do your tax return during April or the filing season, you basically get to skip out on federal taxes. And this is really a problem because you cannot just select exam on your W-4. What the videos are saying is to get a W-4 from your HR, select something called the exam, and then give it back to your HR, and that's it. You just don't have any taxes withhold. And some even go as far as circulating a fake W-4T form online, asking viewers to print that out and write it down and submit it to the HR. We have confirmed with multiple experts that such form does not exist, and this is really a problem with the IRS right now because the reason why these are so dangerous is because if you do such thing, the IRS can come back to you not only asking you for any back pay in taxes that you haven't given, but they can also charge you a penalty and interest on them. But what is even more dangerous is that the fact these videos are very popular on TikTok, and they've been generating a lot of content views. So a lot of people are listening to this.
So, Rebecca, I mean, that begs the question. You talked about some of the repercussions of this. I mean, what is TikTok doing about it?
So far, actually, the IRS doesn't have anything that they don't have the resource to go after all these information as of now. But what we do want to clarify on air is that this is incorrect because you cannot just declare yourself as exempt. While the IRS does have some rules that certain people can claim exempt, it is very rare and not that many people can qualify for. And one of the biggest misconceptions is even if you don't have withholding, when you still owe that tax that you have. So by the end of the year, if you don't have any withholding, you have to pay everything at once. And as we know, for most Americans, that is a very stressful situation. So while the IRS, they can't do anything about it right now because they are still sort of catching up on what is going on. Experts said this is extremely frustrating because the U.S. tax law is already really complicated, and now you have people going onto these platforms and just spreading misinformation. So anytime you see something like this on the social media, make sure you either take it to your accountant to confirm the information or just log on to the IRS website, type it in and see what you get, because then you won't really fall for these false information on social media.
Yeah, some good advice there. Rebecca Chen, as always, thanks so much for that. Let's do a final check here. We're taking a look at shares of Warner Brothers Discovery and Paramount. CNBC now reporting that merger talks have been halted between the two media companies. Paramount has reportedly received several offers in the last few months. David Ellison's Skydance Media, the film and TV studio there, is reportedly still performing due diligence on a potential transaction. There is, of course, Byron Allen's $14 billion offer, reportedly still on the table. And you're looking at shares of Paramount and WBD both climbing higher, but WBD, of course, near that 52-week low there. We're going to continue to track this story and much more here on Yahoo Finance, but that does it for me in this hour. Much more to come. Keep it right here.